Microsoft just hit a $4 trillion valuation. It's only the second company in history that hit that level, and the S&P has been hitting record highs lately as well. Where are we going? Where's the market trending? We've seen a Fed decision, a hawkish Powell, and a strong dollar. What is happening in the markets right now? What should we prepare for as we come towards the last second half of the year? And I've invited a fantastic guest to discuss this. Mel Mattison, he's an investor, he's an author, but also a former fintech executive who really has a grip on what is going on in the markets. And we'll discuss those. We'll start with the macro and work our way to the micro, meaning we'll start with some of the indicators and then we'll cycle a bit through the asset classes because I have a few questions about the dollar, gold, and the markets in general. So before I switch over to my guest, hit that like and subscribe button. It helps us out tremendously, and it's a free way to support our channel. So thanks so much for doing that. Mel, it is a great pleasure to welcome you on Soar Financially for the first time. Thank you so much for joining us.
Thank you for having me. Appreciate it, Kai.
Yeah, really looking forward to this. I'm going to call you a platypus of financial markets. You can do everything, Mel. But maybe we'll start with a very general and a very broad question to set things off, because I really want to know where your head is at these days. But what is your assessment of the economy and the financial markets right now, Mel?
Yeah, I do think we're at a key pivotal point, like literally as we're speaking here, which is as we record, Thursday afternoon, July 31st. We, as you mentioned, we've just had 4 big mega cap earnings in the last 2 days: Meta, Microsoft yesterday, today Amazon, Apple, and we reached what I think is probably a short-term high in the SPX and the S&P today. We opened this morning and got up to 64.27, which is quite a move from the bottom when we were at 48.35 a few months ago in April. And it seemed like a one-way trip up, and I think nothing goes up in a straight line. Trees don't grow to the sky. You have to take a breather once in a while. So overall, from a broader macro perspective, what I think is very, very bullish, medium and longer term, might be ready for a little bit of a break right now, and probably a pivotal moment where we've had what I would call a counter trend rally in the dollar. That's hurt emerging markets. That's hurt precious metals in recent days. It's taken gold down to around 3,300 level. I think there could be slight more downside in gold, but we're much, much more to the upside, I think, coming in the second half of the year in gold, much more upside in equities. But we're kind of at a little bit of a change point. So we can take it wherever you want from here. But today, I think, was actually a really key day in the markets.
Yeah, let's stay on the high level. Let's stay on the macro. Let's discuss some indicators. We had the Fed meeting this week, for example. Let's maybe start there. How important is the Fed funds rate to the market right now? The S&P reacted a little bit. I looked at the chart intra-week, and we saw a bit of a dip around Wednesday in the S&P 500. Jerome Powell staying hawkish, not even touching or not willing to commit to a cut by September. What is your takeaway here, Mel?
Yeah, I mean, I'll be honest. I think Powell's gone pretty hardcore political. I think even though he has this grandfatherly facade, I think underneath it, the stuff that Trump says, which literally today he sent out a Truth Social calling him a loser. I mean, it's pretty hard for that not to get under your skin if you're a human being, right? You got some guy calling you too stupid, too late, and a loser. And that's literally what Trump said in his Truth Social this morning. And I think when you see Powell, he wants to really hide it. He wants to act like, no, I'm way above this fray. I'm Paul Volcker 2.0. But he is doing things very differently than he did things last year. Last year, it was all about data dependency. What's happening? Let's look at the data. Let's look at the trends. The Fed is not about forecasting. Let's look at what the historical data is. He's not doing that anymore. He's now claiming he wants to see certainty of what's happening in coming months. He's basically being as political as I think you could be, while at the same time trying to hide it. And I think it's clear that he's trying to, in his mind, like establish or reestablish some sort of Fed independence. I personally think this is all a joke. I think central banks are basically a joke. The markets are starting to, I think, agree with me. I think he's becoming less and less relevant as time goes on. Probably by the term is over, I mean, people are going to not really even care what he says. I mean, let's take one step back. Okay. So if you look at something and you say, okay, Fed's going to cut interest rates, that's going to, I don't know, free up capital and get the juices going in the economic engine. That's your economic orthodoxy. For people that follow me, they'll know that I'm not an economic orthodox. I'm more of a heterodox type thinker when it comes to economic theory. I actually think that these higher rates on the short end are more or less stimulative. They're essentially providing a 4.25% yield to baby boomers in their money market accounts that they can go out and buy ski trips to Utah with. So I actually don't think that by him holding the line at 4.25, he's doing anything to stop inflation. I think cutting rates would probably be the best thing he could do if he's concerned about inflation. And that it's not a surprise to me that essentially when he stopped cutting, inflation stopped going down. And so this is a little bit MMT like, but I'm not an MMTer in the sense that most modern monetary theorists are coming at things from a liberal left-leaning perspective that then leads them into very prescriptive policy kind of recommendations, such as a full employment mandate and all these other things. What I'm talking about is more of a framework for economic plumbing, which I think is fundamentally different post 1971 ending of the convertibility of USD to gold. It's fundamentally different than it was before Nixon did that. And in this new environment that we've been in for the last 54 years, like interest rates being at 4.25 on the short end are not really affecting the economy that much. And if anything, they're just being stimulative by feeding cash flows to baby boomers.
Yeah, it's interesting. Like I'm just looking at the raw data. Let's just look at inflation data. It's up right around 3%.
Mm-hmm.
The market expects a positive jobs report tomorrow on Friday, and GDP growth is at 3%. So let's just look at hard there. Let's keep politics aside. If you were to look at these numbers, like there's no reason for Powell to cut. Given the understanding, like some guests we've had on the program even said like the rate should be actually higher because inflation seems to be running higher. We're seeing the tariff impacts seep through now. We could even make a case for a higher interest rate right now. Like, how do you counter that? Keeping politics completely aside, or it's very difficult if you, as you said, like you're constantly being belittled. And the photo op with President Trump and Jerome Powell in the construction side of the new Fed office was absolutely ridiculous, in my opinion, because the poor guy looked like such a small man next to Donald Trump. But just looking at raw data, could you even make a case for higher rates here? Like, is he that wrong?
You want to go higher rates, you're going to jack up inflation. Like, yeah, I might be one of your first guests that's going to say if he wants inflation to go higher, he should raise rates. What is he going to do, Kai, if he raises rate? What is that actually going to do? I'm going to tell you what it's going to do. Number one, any short-term debt out there, any money markets, any overnight loans, commercial paper from banks, there's going to be a higher rate on it. That's going to funnel through. The Treasury, which they just had their TBAC, their borrowing advisory committee announcements come out a few days ago. They talked about increasing buybacks. Treasury is already taking over monetary policy from the Fed. The Fed, as we know it, is on its way out. This is just one evolution in a multi-phase, love-hate relationship that the United States has had with central banks. We can go back to the Bank of North America, established under the Continental Congress, the first bank of the United States under Washington, the second bank of the United States, which Jackson ended in 1836. Finally, the fourth central bank that we have, the Federal Reserve. We can talk about periods where the executive branch has dominated the central bank, such as in the 1940s under FDR when they did yield. Like, there's very few periods in the United States where we have an independent central bank executing monetary policy. This is a big myth that the media likes to talk about. Number one, they want to say, oh, an independent central bank is really critical, and that's the cornerstone of modern developed markets. Well, the second largest economy in the world is China. China's central bank is the PBOC. The PBOC, by statute, is under the executive of the communist chairman, Xi Jinping. So look, we live in a world where very large central banks are under control of the executive. So anytime you hear anyone on the media say, you need an independent central bank, all the major economies have independent central banks, they're literally lying. The other thing I will add that is the biggest lie that I see, and Powell said it a million times the other day, is dual mandate, price stability and unemployment. I would ask people, search Federal Reserve Act of 1913 as amended, look up the United States Code, look up what the mandate of the Federal Reserve is. Go to the Federal Reserve website and look at what their mandate is. It's not a dual mandate. It is a triple mandate. It is price stability, employment, and moderate long-term interest rates. In other words, the primary purpose of a central bank is to fund the government. This is why they were created in 1694 under William III, the Bank of England. They've always had that purpose. We are in what I would call an interregnum period between roughly 1951, which was when there was the Fed Treasury Accord, and today, which is a 60, 70-year period, where we have had a 60, 70-year period of a relatively independent central bank focusing on employment and inflation. But that is actually not the standard role of a central bank. It's not the history of a central bank in the United States predominantly. It's the exception, not the rule. And we are going to depart from that as Trump puts his chairman in. He's going to be ushering in a new age of fiscal dominance. The central bank is going to be there to serve the Treasury, to fund the government. This is what makes me so bullish on generally on asset prices, especially things like precious metals and gold in the long term.
Yeah, it's really interesting. Like you've already said that the Treasury's taken over monetary policy. Like, do you see Scott Bessent become the next Fed chair?
He could. There's actually a Fed governor in between Arthur Burns and Paul Volcker. I forget his name. I think it was G. Edward Miller. He went from Fed. He was the Fed governor, and then he left to go be Nixon's Secretary of Treasury. So I've said if Bessent goes into that role, it would be kind of a reverse G. Edward Miller. Also, there is a
Well, didn't Janet Yellen, sorry to jump in, but Janet Yellen, wasn't she Fed chair and then became Treasury Secretary as well?
Yes, exactly. Yeah. And there is some history for finance ministers in other countries also serving as head of country central bank in Japan. That has happened. I just think that this whole idea, to be honest with you, I do think it's. I watch the media and I watch these press conferences and they're kabuki theater to me. It's Powell out there. I put a post out on X yesterday. I said, today is the perfect microcosm of the irrelevance of the Fed. The market's doing fine. Powell comes out and speaks. Market dips. And then all of a sudden, Microsoft Meta earnings come out and anything Powell said is forgotten about and we're up. This economy is being driven by massive macro forces. These are global forces that really trump, pardon the pun, kind of monetary economic concerns. We're in a bit of a Cold War, a multipolar moment for people that follow guys like John Mearsheimer, University of Chicago political professor, talking about how around 2015, 2017, we went from this unipolar moment of United States dominance to a multipolar world with the United States, Russia and China as kind of, people that can't really be pushed around, right? Like Russia has more nuclear weapons than we do. Like we can tell Putin what to do as much as we want, but at the end of the day, we don't control him. We're not in a unipolar moment anymore. We're beholden to China right now for rare earth minerals to essentially create the weapons that we need if we want to continue to say, help out Israel or the Ukraine. If we were in a prolonged military conflict with a first-rate army, not like going into Afghanistan or something, but something against a real foe, we'd probably start running dry of munitions within weeks. And we could not replenish them because we have outsourced our entire supply chain. We have to do this is Department of Defense type stuff. This stuff trumps like Federal Reserve system, and it is a system. It's a quasi-private system. You can go back to 2017 FOIA requests. Who owns the Federal Bank of New York? It's Citigroup. It's J.P. Morgan. You've got these FOMC. You've got governors that are political appointees, so that's totally political. And then you've got bank presidents that sit on the board. How do those bank presidents get there? They're appointed by the boards of the individual reserve banks. How did the reserve bank board governor or board directors get put there? They get put there by shareholder vote. And who are the shareholders? Citigroup, JP Morgan, Wells Fargo. So once the American people, if they ever really truly understand what this independent FOMC board is, representatives of JP Morgan and Citigroup, along with political appointees, then I think they're going to get more and more comfortable. And there's already like an end the Fed movement, like inherent, especially in far right wing, like MAGA type circles in the United States. So you don't have to convince a lot of us that, central banks are not good. And I think we're getting to a point where this country is ready to do a little bit of a switch, which we haven't done, I would argue, in a long time, but which we have done multiple times in our history, which is move away from a central bank to more of a treasury-controlled monetary policy.
No, I think we've covered the Fed enough. I think it's a really interesting topic. Like we still need to talk interest rates, how they impact sort of deficit spending in general on the U.S. debt, and how much of a political incentive there is to cut interest rates. But that's a longer discussion, and we can table that for next time, because I want to cycle through the asset classes a little bit. We started talking about earnings in the S&P 500 earlier. Let's talk about that. Like you've been calling maybe a good segue is to talk about your call for maybe 100 basis point cut versus Jerome Powell staying more hawkish for longer. Like what are the impacts, like potential scenarios on the S&P 500 moving forward here by the year end? Like what?
Yeah, well, we can forget about the Fed. I don't think it matters. I really don't. It's neither here nor there anymore. I think what matters is that we have this huge, you look at the CapEx cycle that's going on right now. You look at the one big beautiful bill with the 100% depreciation. You look at essentially a bunch of foreign direct investment that's going to be coming in as a result of these trade deals that's happening. You're going to have a spurring on of large corporate development at the same time that you're getting productivity increases and deflationary forces from AI. You're seeing layoffs already from Microsoft, from the big tech people. You're seeing higher unemployment numbers in recent college graduates. And so what we have is like a perfect combination for increasing profit margins, increasing earnings, big CapEx spend. This is all like mother's milk of stock indexes. It's profits. It's like easily, I think 7,000 on the S&P 500 by the end of the year. I think we are at a point where a small pullback makes sense. We hit 64.27 today on the S&P in the morning. A 3.5% pullback takes us to 6,200. A 6.5% takes us to 3,000, or 6,000. So somewhere between 6,000 and 6,200. 3.5%, 6.5% pullback makes total sense, but it's just going to be a little bump on the road because we are in this, as I've said, this period of, fiat debasement, fiscal dominance, huge deficits, increasing margins due to productivity enhancements from AI. It's just a perfect recipe for asset price inflation. And I think that, flows into other asset classes as well.
Yeah, I was going to talk with you about M2 money supply reaching record high as well, and how that is impacting overall asset pricing. 7,000 is in the S&P 500. Like, how much are valuations relevant today? Like, do they even matter as we're going through earnings right now? Like, is it more
No.
the outlook, as you said, like it's more the hype? Are we back to the AI hype again? Like for a while, it was the AI trinity that stocks that were moving, but now it seems like it's expanding a little bit more to the overall tech space again, with tariff discussions calming down a little bit as well. Valuations, do they matter, Mel?
I don't think that we're in like a Weimar Republic situation, but if you were, like, what would you rather own? Reichsmarks or shares of ThyssenKrupp? So, like ThyssenKrupp throughout the Weimar hyperinflation, those shares actually held their value because their earnings were nominal. So, if you're going to have a fiat debasement regime, you can expect to not only get like real earnings growth, which is not going to be that great, but I think it's still going to be good from AI. But then you can add on to that like a deflationary or an inflationary or debasement premium of kind of the reduction in fiat value. So this is very nuanced, and I know we don't have like tons and tons of time, but if you think about it, that the actual currency and what that represents being debased because of money printing, money supply, but at the same time there being kind of deflationary forces that allow for things like margin expansion. What you're going to have is you're going to have certain goods, and we have seen goods inflation overwhelm services. Certain goods go up in value, commodities, aluminum, copper, steel, all of these things over the next few months and years likely to go up in dollar terms. Services prices likely to go down because of AI productivity gains. Margins go up, and an overall relative debasement in the dollar, which just adds juice to those earnings gains. And so you just have this asset price bubble, I think, beginning to get inflated. And I do not think we're in late innings. I don't even think we're in middle innings.
When you say the asset price bubble, do you include real estate, precious metals? What else do you throw in there? Like when you talk asset prices, bonds? I would say that.
No, I don't. Not bonds.
Yeah.
Those are
Okay.
the put the stay away from those. Anything that's considered something to keep as a store of value, no. But some stuff that actually has a relationship to nominal growth. So stocks, real estate, gold, Bitcoin, crypto. I mean, all of these things I think are just getting. I think the best thing I could reference it to, and it was right around when I graduated college. I graduated college in 1998. That 1997 to 2000 period, we saw the Nasdaq go from 1,000 to 5,000. Like that's a bubble. And if you haven't seen anything like that, then you don't know what a bubble is. Because if you're thinking that we had a bubble in 2021, no. I mean, the S&P going up 20%, that's not a bubble. The Nasdaq going up 400% in like 25 months, that's a bubble. That's what happened in the late 90s. I think that's what we're heading into.
No, it's astonishing what's going on in the market. I'm just sitting here, just looking at the charts, and it's I got to shake my head sometimes. Looking at valuations. I mentioned Microsoft, Nvidia, over $4 trillion in valuations.
Mm.
It's tough not to believe in the bubble scenario here, but as you said, like we're just in the early stages here still. So really, really interesting. A couple more asset classes we need to talk about real quick here, Mel.
Mhm.
You posted on X about the U.S. dollar and the dollar
Mhm.
strength being played out. The Dixie broke through
Mhm.
100 today.
Mhm.
Explain your thesis behind that. Like, why do you think it's played out? Is the dollar going
Yeah,
to continue to stay
there
strong?
was there's a long-term uptrend that we hit when we got around 96 on the DXY, and it did not surprise me at all that we bounced from there. Something around this 100, at the most 102, somewhere between 100 102 is where I think we top out, and then we start moving lower again. I think a structurally lower dollar is all part of this. This is like a Plaza Accord, 1980s. Again, one of the biggest things from my investment background is just very much like an economic financial historian. So I look at things that a lot of people think are crazy, like reversal central bank independence, and I say, oh no, that's happened actually 3 or 4 times in the United States history. It's not a big deal. We've done it often. We'll probably do it again. A big decline in the dollar, I think, again, you look at what's happened in the past where we've been well over 100 on the DXY, dripped down to 70s. We got up to 114, I believe, in the fall of 2024. We got down to 96. That's a huge decline. Doesn't surprise me that we had a counter trend move here. It wiped out some gains in gold. I think that's nearing its end phase, because we're essentially around 100-day on the DXY. The 100 to 102 is heavy resistance as far as what we broke through. It was support. We broke through it. I don't think we can get through 102. We might have a penny or two to go on the DXY to the upside, but after that, I think we're going to keep heading lower.
Now you just touched on gold. Let's bring that into the conversation. Today, and we don't need to discuss daily moves here in the price chart, but I saw that gold and the dollar moved up higher together, which was interesting to see, because gold bounced back nicely. People bought the dip, obviously. What is your assessment here?
Yeah, I mean, it wasn't just a dollar move yesterday, but it was also yesterday was the last trading day of the August futures contract. There's a lot of times monkey business around, expirations. I think we're basically there. I think 32.40 on futures is probably, like, if we get there, that's a huge screaming buy, but we might not get there. I think basically we had a false breakdown yesterday because of futures expiration, and it happened to coincide with the Fed meeting and a nice move up in the dollar, and it just got a little wonky. We bounced back today despite the fact that the dollar was slightly stronger. I think at the end of the day, gold's a commodity. It's supply demand. Central banks are buyers. They're buying, tons of this stuff every year. Everybody knows that. People understand what's going on with not just the United States, but sovereign governments around the developed world, whether you're talking about, Bank of England, Japan, France, Italy at, 200% debt to GDP. This is just the way things are. And, it's the way things are going to continue to be. And so what's happening is this is now getting into the mindset. This is getting into the retail investor mindset, and eventually it'll probably get into the institutional investor mindset. But that's why people are not really selling. That's why the retailers were buying the dip, because they're just saying, look, we've seen this game before. We sold off in 2020 on COVID. We sold off, in 2018. We sold off in 2022. Meta was an $89 stock. Now it's almost an $800 stock. When you see that type of a move, when you're seeing a stock as big as Meta go from $89 to $780 in less than a 3-year period, and you're saying, why am I selling? You just don't sell. And this mindset is creeping in, and this is going to creep into we are really, we're getting into S&P Ponzi scheme territory. And then you add the MAGA accounts that were part of the One Big Beautiful Bill, where now every child's going to get money thrown into the S&P 500 from the day they're born. You look at, you get a job in the United States, and they automatically deduct money from your paycheck and put it in the S&P 500 unless you tell them not to. The S&P 500 is not what it was 100 years ago. It is now a fundamental retirement scheme for the United States. Capital gains as tax receipts fund the government. In 2022, we lost over $500 billion in tax receipts because the stock market went down 20% and stayed there for a couple months. The United States can no longer afford for a prolonged decline in the S&P 500, and it stays there. All of a sudden, this is Luke Gromen talks about it, that in the Jenga board, the S&P 500 is now the key thing. It's not the bond market anymore that's key. It's the stock market. You take away that stock market, you collapse the bond market, because you collapse tax receipts, you collapse retirement, you jack up transfer payments. And so we are no longer in the same world we were even 20 years ago. It's a whole new world with assets.
Mel, last question, 30 seconds or less. If you find $1 million under your pillow tomorrow morning, how would you invest it?
I would put it in pro rata where I am as someone at my stage in life. I like to be diversified. I can wake up in the morning, gold's down, but stocks are up, or Bitcoin's up. And, so I would be diversified. With gold and as long as I've been an investor, precious metals have been my anchor, because I know that is always going to have its value. And it is something that has held me true for a long time. Before we came on the air, I mentioned on my microphone I was supporting it with a 100-ounce bar of physical silver. I just think you can't go wrong, and I just love the fact that we've now, in the last 25 years, even with dividends included, gold is outpacing the S&P 500, because for so long people called it a pet rock. They looked at it. Keep gold, precious metals as the core of your portfolio. Be diversified: real estate, Bitcoin, equities. Stay away from bonds. You're going to do great.
Fantastic. Mel, really appreciate the conversation. Where can we send our audience to find more of your work?
Mel Mattison 1 is where I'm at on Twitter, and then melmattison.com. And if you're interested in these type of topics, I wrote a financial thriller called Quoz, Quoz. It's available wherever books are sold, Amazon, whatever, audio, Audible, wherever. It's about corrupt central bankers, blockchain, gold-backed central bank digital currencies, all kinds of intrigues. Check it out if you're interested in that.
Fantastic. Mel, really appreciate you joining us. Much appreciated. By the way, you have a lot of imposters on X with a similar Twitter handle or X handle. So really appreciate you joining us, and everybody else. Thank you so much for tuning in to Soar Financially. Don't forget to hit the like and subscribe. We'll be back with lots more here from the road. Take care out there.